Hello everyone, welcome to the channel. Now if you're new to the channel, be sure to like, share, and subscribe because that's the only way YouTube would know that you like content like this and show you more. Also, make sure you hit the notification bell so that anytime I release a video, you'll be one of the first to be notified. Now today what I want to talk to you about is 5 key differences between an IUL and a whole life. A lot of people have been talking about it, so what I want to do for you today is give you 5 key differences so you can decide for yourself what may fit you best based on your situation and based on your personality. So let's get started. So the first key difference I want to talk about today is the cash value growth. In a whole life policy, the cash value growth is guaranteed. So you have guaranteed cash value growth because they're going to give you a fixed interest rate. So regardless of what's going on in the market, if there's a recession, if there's a depression, inflation, stock market crash, it doesn't matter. In a whole life policy, you're going to be guaranteed a fixed 5 or 6% usually, regardless, and it works like clockwork. In an IUL, it's not guaranteed because the credit is based on, the interest you're credited is based on the index that it's tied to, or the indexes that it's tied to, right? So if it had a very bad year, you're going to get nothing. Whereas here, you're guaranteed your 5 or 6% regardless. Here, based on the performance of the index or indexes that you're tied to, that's how your cash value is going to be credited. So you could have like no growth here, right? On the flip side though, if the indexes that it's tied to perform well, then you can get a lot more interest credited than that normal 5 or 6% that you would get here in the whole life, okay? So that's a key difference with the cash value growth. The next thing is the premium. The premium here is fixed. Fixed in the whole life. Whether you pay that monthly, quarterly, semi-annually or annually, you pay a fixed premium, okay? So your premium don't change. In an IUL, your premium is adjustable. You can adjust your premium. IUL stands for Index Universal Life. So it's a universal life policy. In a universal life policy, it would allow you to adjust your premium, right? So for example, if you get into a situation where things get a little rough, what you can do is pay the minimum amount is required to keep that policy in force, right? So it gives you that ability to adjust your premium, and you can get caught up later on if you want. But here, it doesn't give you that. You have to pay that fixed premium, which works for some people. They want to know that they pay this every month, right? It also gives you a guaranteed death benefit here. Benefit here, and it's usually fixed, right? Just like the premium. Over here again in the IUL, it's adjustable. Why? Because if you can adjust your premium, then your death benefit will be adjusted, because remember that premium you're paying goes towards the death benefit as well as the cash value, of course. But if you're paying less premium, then it makes sense that you're going to have less death benefit. So if you started out with a certain amount, let's say it was $500,000 in death benefit, but then you reduce your premium, your death benefit is going to drop. Let's say it dropped $300,000, depending on the premium you're paying. Then if you die during that time, that's the death benefit you would get, not the $500,000. So your death benefit adjusts as you adjust your premium, okay? The next thing I want to talk about is the safety and complexity. A whole life is considered more safe because you know exactly what you need to pay. It's safe and simple. It's safe firstly because it's not tied to any market. You know you're going to get your interest and you're not going to lose anything as well, right? So you know every year this is what you're going to get. Regardless, it doesn't matter if the market is bad, doesn't matter if you're in inflation, recession, depression, whatever, it doesn't matter. They are going to give you 5 or 6%, 5 or 6%, regardless of what's happening. So some people feel comfortable with that. They know I don't have to worry about the market. I don't have to worry about what's going on in the economy. I don't have to worry about anything. I know I'm going to get my interest growth regardless. So some people feel better with that, right? They feel more comfortable with that. It's also simple, right? Very simple in the fact that I pay this amount of premium, I'm going to get this amount of death benefit, and I'm going to get credited this amount of interest. Very simple, straightforward, right? So it's safe and simple here. In an IUL, it's more complex. There are a lot of different options. So first of all, it's not as safe as the whole life because you can have zero credit growth, right? And zero is never good, right? It's better than losses, obviously. It's better, but not getting any credit in your cash that you put it in, it's not a good. People want credit, right? But it's also better than losing. But it's not as safe as the whole life because you don't have the growth. So if the market went down, you could actually stay flat and not gain anything. It's also more complex, right? Because there's so many things you can do with an IUL. You could tie to indexes. You can split it up in different ways. You could put 25% over there, 25%, 50% over there. You can also have the option of saying, I don't want to tie to any index. This year, I just want to get my guarantee. You could do that as well. You have the rate lock option where at some point throughout the year, if you see a rate that you like, you can lock in that rate. And at the end of the year, regardless of where it ends up, you would get the rate that you lock in at. So that could be good for you based on how it end up, or bad for you based on how it finishes. So where you didn't get all the interest that you could have gotten. So it's more complex. Then you have the floor and the ceiling. So it's for people who don't like things that a little more complex, or they might find it confusing. So it's not good for someone that has to actually pay attention and participate. You know what I'm saying? So it's more complex here. So it's less safe, and it's definitely more complex than the straightforward whole life where you just pay your premium, know what your death benefit is, and know what your interest is. So less safe and more complex. Okay, so the final thing I want to talk about, which it kind of overall discuss, kind of cover all these other things that I mentioned. Less flexible in a whole life. Less flexible. Can't change your death benefit, can't change your premium payments. So provides less flexibility. So what you started with, that's what it is, right? Doesn't give you any flexibility to do anything else. Here is very flexible. So if you like flexibility, this is where it's at. IUL, you could adjust the death benefit, the premium. If you run into a situation, you can adjust the premium. Also, it gives you the opportunity to catch up later on if you have that more money. Later on, if you have the money, you can catch up with it. So it gives you that opportunity to make that policy keep going without lapsing if you get into a situation where you need to make some adjustment. So it's very flexible. Plus what we talk about over here, where it gives you many different options where you could actually tie to the index or not tie to the index. You could spread out your the way you want your cash value growth over a number of different indexes, including the fixed account. You could have the rate lock options. There's also options that give you more ability to even earn more, and in which you have to give up some of like a percent of your cash value. So this provides so much flexibility and options, right? Give you more options and flexibility. So if I should sum up what the major difference between a whole life and an IUL here is, I would say a whole life is more passive. So for that person who just want to just put the money in, let it do what it needs to do, and I don't do anything else, whole life is probably best for them. This is more active. So IUL is more active, so you have to, each year, you have to choose the index that you want to tie to, and make your selections, and you can look throughout the year what's going on to see if you want to exercise that rate lock option. So it's more active, but it also gives you, if you're the type that understands what's going on and know what to do and have great knowledge of the market and how it moves, that's probably a better one for you, because you can take advantage of that and gain a lot more in interest than you would in a whole life without jeopardizing any of your cash value that you already have. So you're not going to jeopardize it or lose it. You might stay still, but you're not going to lose it because it's still not invested in the market, even though it's tied to the market. So hopefully that was helpful for you. Hopefully you gained something from it. If you did, make sure you do a comment, or have a question, you want to put it in the comment section. Also, if you are in the market for life insurance and you're looking to kind of see how something like this would work for you and you want a consultation, I'll leave the link below so you can schedule a consultation. And that's it. Hopefully it was helpful. Talk to you soon.